Welcome back to the deep dive. It looks like you've given us a pretty hefty stack of sources this time, all about the world of insurance.
Yeah, this is a fascinating one. It's like diving into the core mechanics of something that affects just about everybody, but we often don't really stop to think about how it actually works.
Right. And even though insurance can seem a bit, dry or complicated at first glance, understanding these basic principles, the foundation of it all, is actually pretty empowering.
I agree. We have a chapter here that breaks down the nature of insurance, all the key terms, and it's really like getting a peek behind the curtain. So what we're aiming to do today is distill all that down, extract the most crucial insights, and really make it clear how those ideas play out in your everyday life.
Okay, so let's dive right in. When we talk about insurance, it all seems to revolve around this concept of risk. But it's not just any kind of risk, right?
Exactly. Right off the bat, the source material makes a really important distinction. The risk we're dealing with in insurance specifically refers to the uncertainty of loss. And even more specifically, it's what they call pure risk.
Pure risk.
Yeah. Pure risk means that the outcome can only be either a loss or no loss. There's no potential for gain. Think about the chance of, say, getting into a car accident, having a fire damage your home, or suddenly needing surgery.
Okay, I see. Those are all situations where there's no possible upside, only a potential downside.
Precisely. And the chapter contrasts this with speculative risk, which is where there's both the possibility of loss and the possibility of gain, like investing in the stock market or even gambling.
So you could come out ahead or you could lose money.
Exactly. And this is key. Insurance focuses solely on pure risk, those situations where the only possible outcomes are a negative impact or no impact at all.
So if you were hoping to buy insurance against, say, a bad stock pick, you'd be out of luck.
You got it. Insurers are in the business of managing potential negative outcomes, not potential positive ones. And understanding that difference is really fundamental to grasping how the whole system operates.
Okay, that makes sense. So we've got this idea of pure risk, the uncertainty of things going wrong. But how do insurance companies actually manage to make this system work? It's like they're making this promise to pay out if something bad happens to you, but how can they be sure they won't go broke doing that?
That's where one of the most powerful ideas in insurance comes in, the law of large numbers. The chapter emphasizes this as the bedrock of the entire industry.
Okay, the law of large numbers. Lay it on me.
Basically, it means that the more similar risks you group together, the better you can predict how many losses will actually occur within that group.
So if you're insuring a small number of things, like, say, 100 houses against fire, you're going to have a much less accurate prediction of how many fires will actually happen compared to, say, if you're insuring 100,000 houses.
Right. With a smaller group, just a couple of unlucky fires could really throw off your predictions and your finances. But when you have a large pool of what the source calls homogeneous exposure units, meaning a lot of similar things facing similar risks, the overall losses become much more predictable.
So it's like you can't tell exactly which house will catch fire, but you can be pretty darn sure that a certain number of houses will catch fire out of that larger group.
Exactly. And this predictability is essential for an insurer to remain financially stable. They can calculate premiums that are sufficient to cover the expected losses while still remaining affordable for individuals.
So it's all about spreading the risk across a large group.
Okay, that makes sense. Now, the chapter also throws around terms like perils, loss, and hazards. Can we unpack those a bit?
Sure. Think of it as a sort of chain reaction. The peril is the direct, immediate cause of the loss. So if a storm knocks a tree onto your roof, the falling tree is the peril.
The specific thing that causes the damage. Right. And the chapter gives examples that are specific to different types of insurance. Like for property insurance, fire is a common peril. For liability insurance, it might be negligence that leads to someone getting injured. For health insurance, it's illness. And for life insurance, well, it's mortality.
Okay, so peril is the what that triggers the problem, and then the loss is the actual impact, the financial damage that results from that peril.
Precisely. The source makes a helpful distinction here, too, between direct loss and indirect loss. Direct loss is the immediate damage, like the dent in your car from an accident. And then indirect loss, sometimes called consequential loss, is what flows from that direct loss, like the cost of renting a car while yours is being repaired.
Right, the domino effect. Now, I noticed that the chapter also talks about the difference between an accident and an occurrence.
Ah, yes. An accident is a sudden event that happens at a specific time and place, like that car crash we were just talking about. An occurrence, on the other hand, can be a bit broader. It could involve repeated or continuous exposure to something harmful over time. Like, think about water damage from a leaky pipe that's been dripping slowly for weeks.
Okay, so accident is sudden and specific. Occurrence can be a more gradual process. Got it. And then we have hazards. Now, these aren't the cause of the loss itself, right? They're more like things that make a loss more likely to happen.
You got it. Hazards increase the probability of a peril occurring. The chapter breaks them down into three main categories. First, you've got physical hazards. These are tangible, observable conditions that make a loss more likely.
Like icy roads increasing the chance of a car accident.
Exactly. Or, the source mentions storing flammable materials improperly, which could increase the risk of a fire.
Okay, that makes sense. Then there's moral hazard, which sounds a little judgmental.
It's not about judging someone's morals, but rather about how certain behaviors can increase risk. Moral hazard refers to situations where someone's dishonest character or actions increase the chance of them intentionally causing a loss.
Ah, so like deliberately setting fire to your own property to collect insurance money.
That's the classic example of insurance fraud. But the source also includes things like drug abuse or engaging in criminal activity under this category, because those behaviors can also increase the risk of certain types of insurable events.
So it's about intentional actions that increase risk. And then the last one, morale hazard, sounds kind of similar.
Morale hazard is a bit different. It's less about deliberate dishonesty and more about a careless attitude or indifference to potential losses, because you know you have insurance.
Oh, like that it's insured anyway feeling.
Exactly. The chapter gives the example of leaving your car unlocked or even running with the keys in it. You're not trying to get your car stolen, but you're being less careful because you know insurance will cover it if it does happen.
So it's like having insurance might inadvertently make some people less cautious because they feel like they're covered no matter what.
Yeah, there's definitely a psychological element to it. Okay, so we've covered perils, losses, and hazards. There's another really important concept that keeps coming up, the principle of indemnity.
The principle of indemnity, what does that mean?
This is basically the core idea behind most insurance contracts. It means that the goal of insurance is to restore the insured to the same financial position they were in before the loss, without allowing them to profit from it.
So if my roof gets damaged in a hailstorm, the insurance company should cover the cost to repair or replace it with a similar roof, but they're not going to pay for a fancy upgrade just because I have insurance.
Precisely. The aim is to make you whole again, not to give you a financial windfall because of the misfortune. And the source points out that most types of insurance, property, casualty, accident, health, they all work on this principle.
Except for life insurance, right?
Ah, good catch. Life insurance is the exception. It's considered a valued contract because you can't really put a precise financial value on a human life. So the payout is a predetermined amount that's agreed upon when you buy the policy.
Okay, that makes sense. Now, another concept that the chapter digs into is adverse selection.
Adverse selection is a big challenge for insurance companies. It refers to the tendency for people who know they're at higher risk of loss to be more likely to buy insurance and more likely to keep that insurance compared to people who see themselves as lower risk.
So it's like the people who are more likely to need it are the ones most eager to have it.
Exactly. And the problem is, the person applying for insurance often has more information about their own risk factors than the insurer does. If the insurer isn't careful, they can end up with a pool of insured people where a disproportionate number are high risk, meaning they're more likely to make claims.
Which it could obviously be a problem for the insurer's bottom line. So how do they deal with this adverse selection problem?
A few key strategies. The chapter emphasizes the importance of underwriting.
Underwriting.
Right. It's the process of evaluating the risk profile of each applicant and deciding whether to offer them coverage and at what price. So underwriters will look at a variety of factors: age, health history, driving record, location, the type of property you're insuring, all sorts of things that might give clues about how likely you are to file a claim.
So it's like they're building a risk profile for each person.
Exactly. Based on that assessment, they might charge a higher premium to someone they deem higher risk. They might offer a policy with certain limitations, or in some cases, they might decide not to offer coverage at all.
Okay, so careful screening is one way to manage adverse selection. What else?
Another important strategy is ensuring large groups. This is especially relevant for health insurance, where employers often provide coverage to their employees.
And why is that beneficial from an adverse selection perspective?
Because when you have a large, diverse group, you're more likely to have a natural mix of people with different risk levels. Some will be higher risk, some will be average, and some will be lower risk. The source calls this a profitable distribution of exposures.
So the premiums from the lower risk people help to balance out the higher claims costs from the higher risk folks. It all kind of averages out in the end.
So precisely. Again, it's the law of large numbers at work, helping to spread the risk and keep the system stable.
Okay, we've talked a lot about the core concepts of insurance, but the chapter also delves into what it calls risk management techniques. These are the different ways that individuals and organizations can deal with the possibility of loss, right?
Exactly, and there are a bunch of different approaches you can take. The first one the chapter mentions is risk avoidance.
Which sounds pretty self-explanatory.
Yeah, it's just what it sounds like, eliminating the activity that could potentially lead to a loss. So if you don't want to risk getting hurt skydiving, just don't go skydiving.
Makes sense, but of course, not all risks are that easily avoidable. You can't exactly avoid driving altogether, for example.
Right, and that's where risk reduction comes in. This means taking steps to decrease either the likelihood of a loss happening or the severity of a loss if it does happen. Think about installing smoke detectors in your home. They won't prevent a fire from starting, but they can significantly reduce the damage and potential for injury if one does occur.
Okay, so you're not eliminating the risk, but you're making it less risky. And then we have risk retention.
Right. Risk retention is basically the decision to accept the possibility of loss and deal with it yourself. It can take different forms. Choosing a higher deductible on your car insurance is a form of risk retention. You're saying, okay, if I have a minor accident, I'll cover the first part of the cost myself.
And the chapter talks about self-insurance as another form of risk retention.
Yeah, self-insurance is a bit more deliberate. It's where an individual or organization sets aside funds specifically to cover potential losses. It's important to note that this is a planned strategy, not just simply being uninsured and hoping for the best.
So it's like having your own little internal insurance fund.
Precisely. And it can be a good option for some, especially for larger organizations that have the resources to manage this themselves.
Okay, so we've got avoidance, reduction, and retention. What else?
The next one is risk sharing, which is also sometimes called risk pooling or loss sharing. This is where the financial burden of a potential losses is spread across a group of people.
Ah, this is where insurance really comes in, right?
Exactly. A classic example is co-insurance in health insurance, where you pay a percentage of your medical costs and the insurer pays the rest. The source also mentions reciprocal insurers as another form of risk sharing. These are groups of individuals or organizations that band together to insure each other.
Okay, so it's all about sharing the burden. And then, of course, we have risk transfer, which is probably what most people think of when they think of insurance.
Yep. This is where you shift the financial responsibility for a potential loss to another party, typically an insurance company, by paying a premium. Buying an insurance policy is the most common way to do this.
So instead of bearing the full weight of the risk yourself, you're paying someone else to take on that responsibility.
Exactly. And the chapter also mentions things like hold harmless agreements as another way to transfer specific risks. These are clauses in contracts where one party agrees not to hold the other party liable for certain types of losses.
Right, like if you're hiring a contractor to do work on your house, they might have a hold harmless agreement to protect themselves from being sued if someone gets hurt on the job.
Exactly. And then there's reinsurance, which is, well, kind of like insurance for insurance companies. It's a way for insurers to transfer a portion of their own risk to other companies called reinsurers. This helps to protect them from potentially catastrophic losses that could result from, say, a major natural disaster or a huge lawsuit.
So it's like a backup layer of protection for the companies that are providing the initial layer of protection. Makes sense. Now, one thing I was wondering about is, even though we've been talking about all these different ways to manage risk, I know that not every risk is actually insurable.
Right. There are certain criteria that a pure risk has to meet in order for insurance companies to be willing to cover it.
Okay, so what makes a risk insurable? What are the key elements?
The chapter lays out several essential criteria. First, the loss has to be accidental, meaning it happens by chance and is outside the insured's control. You can't intentionally cause the loss and then expect insurance to cover it.
That makes sense. It needs to be something that's unforeseen and unintended.
Precisely. It helps to prevent fraud and also ties back to that concept of adverse selection we were talking about earlier.
Okay, so the loss has to be accidental. What else?
It also has to be definite and measurable. This means that you have to be able to clearly determine when and where the loss occurred, what caused it, and how much the financial impact is. You need to be able to put a dollar figure on it.
Okay, so there needs to be a way to quantify the loss. What's next?
Another big one is that the loss needs to be predictable. For an insurance company to be able to set premiums and stay in business, they have to be able to estimate how frequently certain types of losses are likely to occur and how severe those losses will be on average.
Which goes back to the law of large numbers, right? Having enough data to make those predictions.
Exactly. Now, the chapter also says that the loss can't be catastrophic. This means that it can't be something that would affect a huge number of policyholders all at once, leading to losses so big that the insurance company couldn't possibly pay all the claims.
So things like war or a major nuclear disaster, those would probably fall into the uninsurable category.
Right. Those events have the potential to cause such widespread simultaneous losses that they would overwhelm the capacity of most private insurance companies to pay out.
Okay, so the potential for loss needs to be manageable for the insurer, and then there's the need for a substantial number of loss exposures.
Right. You need a large enough pool of similar risks for the law of large numbers to do its magic and provide that predictability we were just talking about. If the risk is too isolated or unique, it's much harder to insure.
Makes sense. And then the final criterion the chapter mentions is that the premium cost must be economically feasible.
Right. The cost of the insurance has to be affordable for people to buy, and the premium has to be significantly smaller than the potential loss being covered. Otherwise, there's no real financial incentive for people to purchase the insurance in the first place.
Okay, those all seem like pretty logical requirements for something to be insurable. Now, I know that insurance companies don't just give a simple yes or no when someone applies for coverage. They also categorize or classify those risks, right?
Yep. During the underwriting process, insurers assess each applicant's risk and put them into different categories based on how likely they are to file a claim. The chapter talks about three main classifications. Standard risks are those that fall within the average range of risk for that particular type of insurance.
So they get the standard premium rate.
Exactly. Then you have substandard risks. These are the applicants or situations that the insurer sees as having a higher than average chance of experiencing a loss.
So they might be charged a higher premium to reflect that increased risk.
Right. Or they might be offered coverage with certain limitations or exclusions, or in some cases, the insurer might decline to offer them coverage altogether if they deem the risk to be too high.
And then at the other end of the spectrum, we have preferred risks.
Preferred risks are those that the insurer sees as posing a lower than average risk of loss. Because they're less likely to file claims, these applicants typically get rewarded with lower premium rates.
So it's all about assessing the probability and potential severity of losses and then pricing the insurance coverage accordingly based on these risk classifications.
Precisely. It's a constant balancing act for insurance companies understanding the risks, predicting potential losses, and managing the financial side of things to ensure that the system remains stable and beneficial for both the insured and the insurers.
Well, this has been an incredibly informative deep dive into the fundamental concepts of insurance. We've covered a lot of ground, from the basic definition of risk and the all-important law of large numbers, to the principle of indemnity, the various types of hazards, the techniques we can use to manage risk, the criteria that make a risk insurable, and those risk classifications that insurers use. It's a lot to take in, but hopefully it's given everyone a clearer picture of the underlying mechanics of this complex system.
Absolutely. The key takeaway here is that insurance is, at its heart, a way to manage the uncertainties of life, those pure risks that we all face. It relies on spreading the risk across large groups and carefully assessing individual risks to create a system that's both fair and sustainable.
And as you go about your day-to-day life, I encourage you to think about how these principles play out in the different types of insurance you encounter. Whether it's car insurance, health insurance, homeowners or renters insurance, or any other kind, consider how these ideas are at work behind the scenes. What risks are you actively trying to avoid? Which ones are you taking steps to reduce? Are there risks you're comfortable retaining through things like deductibles? And which ones are you transferring to an insurance company? Understanding these basic building blocks can really empower you to make more informed decisions about your own personal risk management strategies and to navigate the world of insurance with more confidence.
It's about taking control of those uncertainties and making choices that align with your own comfort level and financial situation.
Exactly. So the next time you get an insurance renewal notice or you're thinking about buying a new policy, remember that it's not just a piece of paper. It's a complex and fascinating system built on these fundamental principles that we've explored today.
And hopefully now you have a deeper understanding of how it all works and how it can work for you.
Thanks for joining us for this deep dive into the world of insurance. We'll see you next time on The Deep Dive.